about improving your business's profitability. And today our subject matter expert is Eloise. She actually specializes in small business consulting and coaching and has over 28 years experience. So we're definitely going to be learning a lot today, and I will pass it over to Eloise.
Well, good afternoon, and thank you, Carla. And Carla, I did manage to get in, so to let you know that I actually am seeing the slides, so we're all good for moving forward. So if I can just ask you to click on to the next one, and then we can get started. Great. So I just wanted to give you a little bit of background. Carla explained a little bit about what I do, but I'm very passionate about working with small businesses and helping them move over into a new dimension of taking their business to results that they've never experienced before. And part of that is really helping them understand how they can increase their business profitability. That's really key and foremost, because at the end of the day, yes, you are in business to attract and retain customers, but you also want to make sure that you're doing it as profitably as possible. So if we just click to the next slide, Carla. Perfect. So question for you, how can you increase profits? Well, that's a really big question, and there's mainly two areas that you can increase profits with. One is related to increasing your sales, because the more sales you make, if you do them profitably, that's going to fall down to the bottom line. The other often overlooked area is pricing, and really understanding how to analyze your pricing on products and services so that you can increase your profits. Next slide. So how we're going to do that today is there's three objectives that we're going to be covering. The first one is to understand the impact of costs and expenses on your break-even point. The second point is to learn the impact of gross margin and cost markup methods on your profitability. And the third one is building a pricing model to understand the impact of pricing and the effects discounts can have on your business. Now, I've separated this webinar into these three components because what I find from working with clients is the first thing that you really need to understand is a little bit about the definitions and the impact of what these can have on your business. The other thing is to understand the differences in how you can price. And those are the gross margin and cost markup methods. And the way that you use those can also have a difference in how and what your profitability is. And then building a pricing model. And this is usually, honestly, when a lot of people start to get, oh my goodness, but it's actually a lot simpler than you think. And I'm going to be showing you a little model today, a little template, which I'll gladly send you, and we're going to talk about that towards the end of the webinar anyway, to be able to help you do this and get better control with your pricing. Next slide. So we're going to start with some definitions of some key terms and some questions that I want you to be thinking about related to that. Then we're going to spend some time going over the two pricing methodologies, which is the cost markup and the gross margin pricing model. And then I'm going to walk you through a pricing model analysis, and we're going to talk about discounts because I can tell you that this is one area that I definitely see business owners need to get better control over. And once they understand the impact by using a pricing model to understand their pricing, they can see it more clearly and make better decisions so that they don't affect their profitability negatively, which is what we really want to be very concerned with. Let's go to the next slide. So we're going to start with definitions. And the first definition that I'm going to talk about is the cost of goods sold. What I find sometimes is small businesses aren't necessarily separating their cost of goods sold out of their expenses. So I want to make sure first and foremost that this is what you're going to do, is to make sure that you separate your cost of goods sold, and the definition of that are all the costs that are related to the product and services that you're selling. You know, if you've ever heard of the terminology landed cost is representative of all those costs that you need to incur to get that product or service ready to be able to sell. So what falls under the cost of goods definition is your fixed costs that are specifically related to the equipment that you require in order to produce your product or services. There's other variable costs as well that are volume related, that are related to creating of the materials and products. So there could be raw materials, there could be overall complete materials, there could be a series of things that are variable, meaning that you buy them based on what it is that you need, and it's based on the volume that you're looking for. Fixed costs are a little bit different when it comes to cost of goods sold, because you could be buying a piece of equipment and that's going to be used to create a number of things for you in your business. So those become fixed. So the important thing here, and I'm just going to ask you to do a couple more clicks for me there, Carla. Perfect. And one more. Perfect. All right. Oops. We'll go back. There we go. So what I want to make sure that you understand with cost of goods sold is that the fixed cost component, just like that little graph on the right, shows that they stay constant. Your variable costs are the ones that are going to increase, because the more you sell, the more variable costs you're going to have. But your fixed costs are going to stay the same. The only time your fixed cost amount is going to change is if you end up maxing out on your capacity and you have to invest more in more fixed costs. So that's the first thing I want you to be thinking about is, okay, am I looking at my cost of goods sold, and do I understand my fixed cost component versus my variable cost? And then I want to ask you to ask yourself this question: how are you defining and allocating your costs today? Because looking at this graph, you can see that you're going to have to be at a particular dollar level just to offset your fixed cost. And we're going to talk more about that later on. But I wanted to put this little graph in here so you could understand that, hey, even right out of the gates, you're going to have to be selling so many units to be able to recoup your fixed costs. And then, of course, your variable costs. So how are you defining and allocating your costs today? And that, I hope, is going to be a little bit of an exercise for some of you, because it's actually going to uncover some real interesting pieces of information that you're going to need to increase your profitability. And then I want to ask you what level of review you have in place to regularly review this. This is really important, because when you start to understand your business through cost of goods sold, looking at what's costing you to produce these products or services, you're going to be able to have a better handle on the kind of sales volume that you need to generate profits and more profits. The other thing that this is going to do for you is that it's going to allow you to address more specifically a particular cost that you may want to be investigating. So let's take fixed costs, for example. By you starting to look at your business this way, and you're looking at the fixed cost that it's costing you to produce your products or services, you may say, hey, I have an opportunity here to look at reducing my fixed costs. Naturally, that's going to happen and impact your profitability. Variable costs the same way. You tend to have as more flexibility sometimes in fixed costs, because often these get overlooked. And that's what I find with working with business owners, is they're not looking at these separately and then investigating them periodically to see if there's ways that they can further reduce them. The third reason why you want to be looking at your costs this way as well is because if you segment your costs and look at your profitability after cost of goods sold, you're going to be able to then compare to industry benchmarks. And that's really important, because you want to make sure that you're doing as good as or better than a similar company in the same kind of industry that you have, because then you know your competitiveness is in line as well. And that's really important, because that ultimately affects your profitability too. Next slide. Now we're going to talk about gross profit. And gross profit is the difference between sales and cost of goods sold. Gross margin generally is stated in a percent. It's basically gross profit divided into sales. And gross margin dollars is the same as gross profit. So if you just give me one more click there, Carla, because there's a couple of numbers, and then one more to bring up the little box underneath. Perfect. Okay, so let's go through this example. And this example with these dollars and cents I'm using throughout this webinar. So this is an example where the sales are $125 and our cost of goods sold is $75. So our gross profit is $50. Our gross margin is 40%. That would be the 50 divided into the 125. So you want to make sure you understand the gross profit that you have for your sales. Now, for some of you that are selling just one product or service, it's going to be relatively straightforward for you to do this. For those of you that have more than one product or service that you're selling, this could be a bit bigger of an exercise to do. But I encourage you to start doing it. And I would encourage you with the 80-20 rule. So focus on 20% of those products or services that are driving 80% of your revenue, and make sure that you can determine what the gross profit is individually. Because you may uncover, and I'm going to be talking about this in a couple minutes, some products and services that aren't making enough money for you. We call those dogs as opposed to cash cows. So my question for you here is, how have your margins been tracking? And this is something that I encourage you to look at, your gross margins, not only in determining them, but tracking them and looking at them at least monthly. I've got some clients that we look at this weekly because there can be such fluctuation depending on the specific products or services that are being purchased. But at a minimum, you want to look at them monthly. And then the question is, so I'm looking at them monthly, Eloise, so what do I compare them to? Well, here's some suggestions. The first thing you want to compare them to is how you did to a previous period. So how did you do to how the margins were last month, or the quarter before, or the year before? Another thing that you want to look at is how you're doing to an industry standard. And there's lots of things that you can do to get industry standard information. As a matter of fact, that's one of the things, if you want to get it from me, you can actually send me an email at the end, and I will send that to you so that you can actually use that as a benchmark. And what that will allow you then is a way to compare. And when you can compare yourself against something and you determine your gross margin is not as high as what it should be in your particular industry, that should give you something to think about. Okay, I got to dig in and work on reducing my cost structure, or look at my pricing so that I can get to the same level of profitability that is standard in the industry that I'm in. Next slide. So now we're going to talk about expenses. Now, expenses in my definition and in most accountants' definition are different from cost of goods sold. They're not related to generating the cost of goods sold directly. And they include, similar to cost of goods sold, you have fixed expenses and you can have variable expenses. Variable expenses I call discretionary. Discretionary expenses in the purest term mean they're expenses that you can decide whether or not you're going to spend them and to what level that you're going to spend them on. When you are looking to improve your profitability, the discretionary spend tends to be what people look at first. So what you want to do is you want to be clear with what are those discretionary spends, those ones where you can make changes. And, I put office supplies down here because I'll tell you that is a real creeper. That one can creep up so easily in businesses. The other one is travel. Those are the two, in my experience, that I see are the ones that get out of control the fastest. So those would be the ones that I would suggest that you investigate quickly to see whether or not there's opportunity to reduce those, because that's going to have a direct impact to your bottom line as well. Let's talk about fixed expenses. So fixed expenses, and I put down here headcount because in most businesses that can be a fixed expense. It's not as variable unless you do have a lot of flexible, permanent, part-time employees. So when you're thinking about your fixed expenses and what you can do about that, you want to be thinking about, okay, What can I compare it against? And so this is, again, when it's really great to have some industry benchmarks to compare it to, or to be looking at it as a percentage of your overall sales. And then what I would say to you is look at it as a percentage of your overall sales today, but do the same exercise to how it looked last year. Because what you want to do, and by the way, if you're ever thinking about getting some additional financing, banks look at this as well, is they want to make sure that you're not getting creepage here. Creepage where your expenses are increasing as a percentage of revenue, because that's signifying that you might have an expense problem. And if your expenses are creeping up, then you want to be looking into that to bring it back down again. So questions that I want you to be thinking about here are the ones that are here. So what are your biggest expenses? Know what those are and look at them. Compare them to what they are against sales and compare them to what they are against sales last year and see what that percentage looks like. The other thing that I want you to be clear about is how much discretionary spend do you have? You need to know this because if you have any kind of seasonality in your business, or if something happens and all of a sudden your sales aren't coming in the way that you want to, this is the first place that you're going to go to make some decisions to streamline and cut them back. Because you want to maintain your profitability. You can't do a lot in the short term on fixed expenses, but variable expenses and discretionary expenses you can. The third thing I want you thinking about is how are you controlling them? Now, big companies have all sorts of rules and procedures for approving expenses. Small business doesn't have that luxury. So what I would encourage you to do is to make sure that those ones that are significant, that you are controlling them. Office supplies is an example. That is something that should be centrally maintained and controlled because that one can definitely increase. Travel expenses is another one. And to make sure that you've got, everybody thinks about leveraging the cheapest travel arrangements that they can come up with. I'm talking about looking at your overall spend in that area and making sure that it's not creeping up unnecessarily. The next slide. Okay. The next thing I wanted to talk to you about is contribution margin. And this is a very important concept when you are looking at trying to make decisions in your business. Understanding the contribution margin in dollars, which is by definition sales less variable cost, is going to give you a number to be able to know in your business for those products that's contributing to your overall profitability. It's an excellent way to compare products or services between each other. And it's a great opportunity to be able for you to look at to further reduce your costs. This is when you start to uncover and shake out the cash cows and the dogs in your business. And that's really important to do. At a minimum, once a year, you want to be looking at your contribution margins by major product or service area. For those of you that are in a very dynamic industry, you want to be looking at it probably more frequently because you really want to understand your segmentation between, because of course, if you've got more cash cows, that's what I would be saying to you. Okay, so how do we sell more of those? And for the dogs, how do we sell less? And it may be, how do we reduce our costs? And it may be, in some cases, how do we stop selling those entirely because there's no way that we can make enough money selling those. So those kinds of discussions happen when you start analyzing and looking at your business through a contribution margin approach, which is sales less variable costs. And it's don't get overwhelmed with this because it's actually a lot of fun. Because when you start looking at it, you kind of go, geez, I didn't realize this, that these would be generating this much more profit towards my bottom line. I'm going to sell more of those. And it's amazing because you're going to have a huge impact to your bottom line in a really short period with increased profitability when you start honing in on those cash cows right away. The next slide. Okay, so now I want to talk about the checkpoint. And the checkpoint is know your total fixed costs and expenses. You got to know what that number is, because your total fixed costs and expenses, and that's why I put in here, what is your number? I have a client that said to me right away, $125,000. He knew his number exactly. And the reason why you want to know that number exactly is because that's the baseline that you've got to recover through profits. So you want to be looking for ways to minimize these as well. And, there's all different things that you can do here. As one of the things that I'm going to be offering at the end of the webinar as well is what I call PIC, a profit improvement checklist. And in there I've outlined a couple of different ways that you can look at, well, not a couple, but quite a few, of ways to minimize these areas. But this is when you start digging in and looking at your occupational costs and a couple of other key big areas to see what you could do. But at the end of the day, you got to know what that number is to begin with, because knowing that number is honestly the first step in getting better control over your profitability too, because that's going to tell you what you absolutely must recover. You've got to sell enough profit. Remember when I talked about gross margin and gross profit, you've got to sell enough things that's going to give you enough profits to recover what it is that you have in total fixed costs and expenses. So let's go through to the next slide. So this is probably one of the most important numbers beyond your fixed costs and expenses that you must know. And it's called break even. And break even is what volume of units do you need to sell to recover all your fixed costs and expenses. Now, I put 2 points down here. I put calculate the total and then calculate for each product or service. So calculate the total could be for those of you that just have one product or service. That's relatively straightforward. For those of you that don't, that have a series, what you want to do is you want to take the average profit across the board in your company and in your business so you can see what it is overall. So my question to you is what is your break-even level? So today, what I want to know is I want you to give some feedback. And on the bottom here, you see where you can go cold to hot. I want you, for those of you that know what your break-even level is, I want you to go hot. Okay, I want to see how many of you are comfortable with knowing what your break-even level is. So if you want to just give that little meeting temperature gauge there, is that right to say it that way, Carla, for them to show? Because it's hard. I'd like to get to know how many of them actually know what their break-even point is.
Yeah, they could do that way or through the chat.
Okay. So let's see. Okay. Did you see? Let me just flip over to the chat here so that I can make sure that I'm seeing what. Okay. All right. I didn't see anybody indicate what that they understand it. So whether or not they know their break-even level or not. So I'm just going to move on and see. Oh, I'm in the cold. Okay, all right. Okay, so we got some that's in the cold. All right. And you know what? I really hope that this is the one thing that you're going to take away from today is to make sure you figure out what this is. So let's go to the next slide because I'm going to show you how to figure out what it is. So here's a break-even working example. So this is an example where the selling price is $125,000 again, and in this particular case, the fixed costs and expenses total in this business is $250,000. Now, I put an asterisk beside this because what I want you to make sure is that you include inside your fixed costs and expenses what you want to be making, because you want to make sure you're recovering and paying yourself. That's first, you want to make sure of that. So that's why I put a little asterisk there on that. The other thing is, the reason why I put that is because, first of all, you want to make sure that you're also including what it is you're going to be paying yourself. The other thing that you want to have and know what that number is because you want to use that for competitive analysis too. Because when you know what your overall expenses and fixed costs are in this area, then you have another piece of competitive intelligence that's going to help you as well ultimately in improving your profitability. And in this example, we have a variable cost of $75. So the break even is when you take total fixed cost and expenses divided by selling price versus variable cost. If you want to click one more time, Carla, perfect. All right. So step one, 125 minus 75 gives you 50. And we take the $250,000 of the fixed cost and expenses and divide that by the $50 gross profit that we get. That means that this particular business has to sell 5,000 units to break even. Click to the next slide. Therefore, the sales must be at least 5,000 units times $125 comes to $625. So what is your total sales that are needed, and how are you tracking it? So let's think about this number for a second. I know it's a big number, but this particular business also happens to have a $250,000 worth of fixed expenses and costs that it needs to recover. So $625,000. Now let's think about how we can start using this number to help you better manage your business. So if you know that you need to sell $625,000, you can start looking at this number in a variety of ways. I would actually break it down to the number on a daily basis that you're looking for to get. So if your business is open and it's open 5 days a week, you have 260 days of business that you're dealing with. Take that $625,000 and divide that by 260, then that means that you need to be selling $2,403.85 a day. All of a sudden, it becomes a much more manageable number to be able to communicate and understand on a daily basis that you can measure your staff against for those of you that have staff or salespeople. You know what number it is that you need to make on a daily basis to recover enough to be able to have a break even. Next slide. Okay, so now we're going to talk about gross markup and gross margin pricing methods. And honestly, I hope to now you're feeling okay about the numbers, because I can tell you, and if you're a little bit shaky, about numbers coming into today, don't worry about it, because that's very, very normal. I want you today to just be focusing on these key ones, and you're going to be so much further ahead than what you were before you joined the webinar today, and that's the most important thing. So you're more comfortable, and you can start sort of looking into some of these inside your own business. So let's talk about the two pricing methods. One is cost markup, and the other one is gross margin. So cost markup is when you add a dollar value to your cost to determine a selling price, or sometimes you'll hear people say, oh, well, I'm just marking up my costs, and that's when they use a factor to determine the selling price. Gross margin, on the other hand, is when you're using a predetermined margin. We say, I want to be making 45% margin, I want to be making 40% margin on my products to use their selling price. Now, some people think that these two methods are the same. They're not. And the next slide is going to show us why. So on the left-hand side, it shows you the cost markup model. So this is where our cost is $75, and our markup is to be 40% or $30 in this particular case. So our selling price would be $112.50. And how that's calculated is the $75 cost from the example plus the $30, or the 75 times 1.4, so 1 plus the 40% to come up to a multiple of 1.4. And that shows then that we're looking at a 105, which your profit then becomes 30. If we go to the example on the right, our desired margin is 40%. It's calculated as $75 divided by 1 minus 0.4, which comes to $125. The gross profit in this particular example is $50 versus the other one, which is showing $30. Let's go to the next slide. This is why you want to know which methodology that you're using with. Because when you start increasing along margins, and when you say, listen, I want an 80% gross profit, that blue line is the one that represents the gross profit using the gross margin to calculate the selling price. That gross profit is $300 at the gross margin of 80%. When you're using a markup of 80%, the gross profit that you're going to get is just over 50. So that's why you really want to be clear, because the profitability that you get between one pricing methodology and the other is dramatically different. Very, very different. Let's go to the next slide. Okay, so I promised you a basic pricing model, and this is the basic pricing model. We've only got a couple more slides to go through, and these next three slides are very similar. So I'm just going to walk you through this one, which just shows overall the break even. So how we calculated the break even before. So 125 is the price per unit. 5,000 units, the variable cost is 75. And if we look down, we can see the fixed, which I've highlighted in yellow for you as well, is $250,000. And that $250,000, in order for it is showing a profit of zero, because we have sales revenue of $625, our variable cost is $375, which is the multiple of the 5,000 times the 75, and we have our fixed cost of $250, which shows a profit of zero. That's that break-even sales volume in the green that I'm showing you. So this is just a little Excel spreadsheet that I have set up to be able to do this. Let's go to the next slide. So this is what happens when the price point is $145 instead of $125. Now the profit is $100,000. So $100,000 is what the profit is showing. So this is showing you then, and this is when it gets to be fun too, because you can say, okay, I know my break-even point is $125. So what happens if I raise my selling price to $140? Having this little model in place is going to allow you to see what the impact is of that. Now let's go to the next one. This is what happens with discounts. And that's why having these little models set up is really going to be helpful for you, because you can also play with it with discounts. So this particular case, I discounted it by 10%, and that's where the $112.50 came in. Well, you can see right away that it's $62,500 negative profit, so a loss. And this is important to know. And if you're using this little pricing model and looking at your different products and services, you can start to make some really good decisions to see where you can and cannot afford to be able to discount. There could be some products that are going to be easier for you to put discounts on than others. And that's important to know, because if you're just blanket discounting, you could be adversely affecting your profitability, and you don't want to be doing that. So using this little model and setting it up is going to allow you to be able to play through different scenarios and make some decisions to be able to help you increase your profitability. Let's go to the next slide. Okay, so the next steps then to get more control over your profits are this. Step 1 is know your break-even point. Step 2, review your pricing and discounts. Step 3, make sure you understand your costs and expenses and separate variable versus fixed, and put a plan in place for regular review and reduction. Step 4 is analyze your products and services. Make sure you know your profit generators and address your profit eaters. And I talked about those earlier when I said, well, your profit eaters, or your cash dogs or dogs, those are the ones where you have to make a decision. Can you reduce your costs so that become more profitable? Can you increase their selling price so that you can become more profitable? Or can you stop selling them so that you're not losing money on this? And you know, sometimes I had this happen with one of my clients this week. It can be a real eye-opener, and you know, you have to make some decisions, But unless you're deliberately selling it below cost for a lost leader reason, I really don't understand why anybody would want to be consistently selling products below cost. You've got to come up with a better way of being able to address that. But unless you do the analysis, you're not going to know. So step 1, know your break-even point. Step 2, review your pricing and discounts. Step 3, make sure you understand your costs and expenses. Separate the variable from the fixed. Put a plan in place to regularly review and look for opportunities for reduction. And step 4, analyze your products and services so you know your profit generators and you can address your profit eaters. Now, I put 2 things down here for tools to help. One is the pricing matrix model. So that's basically that little Excel spreadsheet that I just took you through. And also the PIC, the Profit Improver Checklist for costs and expenses. So go to the next one. And that's it. That's it. I hope that you were able. I know I covered a lot, and don't be afraid of numbers. They're your friends, and when you work with them and understand them, and that's why today I really wanted to sort of separate cost of goods sold and talk about profitability and expenses and break even, because just understanding those concepts and working with those is going to have a huge positive effect on your business. And I encourage you to, ask questions now. I think, Carla, is that what we generally do at this point in time?
Yes, absolutely. So thank you very much. I always learn something from you, so it's great. And I love that you actually made me think that break-even and contribution margin is fun.
It is.